Hey there, welcome to the next lesson in my course on creating 5-year financial models in Excel. If you haven't seen the previous videos, you can find links to them in the description below. And if you want to download the Excel files and follow along, you can do so on the first link in the description below. Now let's get back to Excel. In the last video, we built our acquisition debt schedule, and in this video, we're gonna focus on our cash conversion cycle. I'm gonna grab a new heading, paste it over here, cash conversion cycle. Let me just add a few more lines here, and let's just go to our corporate tab and grab the structure from here because it's gonna be pretty much the same. Copy all that, paste it over here. So let's start relinking. We don't need anything in those first 3 years. We can just delete everything, and our revenue, we can link to our income statement. Then we need our accounts receivable days. But what days are we going to use when we don't have any historicals to base this metric off? What we can do is we can grab our common size metrics and use those. So just grab this, name this cash conversion cycle assumptions. Just have days at the top, which is going to be 365, Control Enter. And then just to make it a bit tighter, we just have revenue, receivables, accounts receivable days, have supplies from our income statement, inventory, our inventory days, and we'll have operating expenses from our income statement, have payables, and accounts payable days. Those will be the important things. So let's use our format painter and have inventory days and accounts receivable days. Let's link our revenue to the core business. Copy that over to the side, format it as a number. In fact, let's format everything as a number. Our receivables, I'm not even gonna bother with calculating average receivables because this is an aggregated view of the core business and we're looking for directional assumptions. So I'm just gonna link this directly to accounts receivable. Copy that over to the side, and our accounts receivable days are our receivables over our revenue multiplied by our days. I'm actually gonna fix days on the row. Okay, and then we can copy and paste this here. Our supplies, again, from the core business, link here, and our inventory, again, no average, just link it directly from the balance sheet. And the days will be calculated automatically. And same thing here, our total operating expenses. Copy it over to the side, and our payables balance from the balance sheet. Accounts payable. And this again calculates automatically because we fixed the days on the row, and it's the same logic for all of those three. Now that we have those calculated, we can move back to our acquisition pipeline and start linking them. Let's link this. So our accounts receivable days from our common size for 23. Remember which year we're linking to. With 28, and I'm actually gonna copy this over to the side. Make sure that there's no fill and that it's green. I'm gonna copy the same formatting here and here. I'm just gonna link those as well. Inventory days for 23. Copy that over to the side. And payables days from our common size from 23. Also want to bold those, make them a bit more visible. And the only thing left to do is, because we don't have an opening balance, I'm just going to link it to this balance here. And I'm also going to note that this is a formula that doesn't match the other formulas. Same concept, and it gives us the closing balance of accounts receivable. We can do the same for inventory and accounts payable. Just going to grab this opening balance and paste it here and here. And then let's go ahead and link our supplies. Copy that over to the side, and all the formulas are working for the average balance and the opening balance, and it calculates all the way through. And we only need to link the operating expenses here, and payables will also be calculated. So total operating expenses, copy that over to the side, and we have our payables and our net working capital with the change in net working capital. We can now link those three balances to our balance sheet. Go down here, accounts receivable be equal to our accounts receivable closing balance. Copy that to the side. Our inventory, link it to inventory closing balance. Copy that to the side. And our accounts payable, we link to accounts payable. And we can also link the changes in working capital in our cash flow statement and carry that over to the side. Let's start a new section in our assumptions about the acquisition price split. Remember, when we have a purchase price, we need to split it between some assets and goodwill. And for the purposes of keeping it simple in these models, we're splitting it to PP and goodwill. Don't get me wrong, this is something that I almost always do when I'm building models in my work, because it's much simpler to do it that way, especially when you don't have a lot of visibility, as it is with an acquisitions pipeline where those are not even identified companies. So I would always split it between PP and goodwill just to make sure that it's in the right place in the balance sheet. And I wouldn't give too much thought whether it's an intangibles or PP. Really doesn't make any difference for the purpose that we're building this strategic 5-year financial model. Go ahead, add a few more lines here, and grab one of the orange headers. This is going to be our acquisition price split, which we'll use to calculate our acquisitions of PP and goodwill and also our other liabilities. Assumed split between PP and goodwill, have PP, goodwill, bold that, and those I want them to be bordered, and this is going to be an assumption. So let's make it an assumption and just going to keep it at 50%. 50%. So now we have the total acquisition cost down here, which will link from our acquisition assumptions. Copy that over to the side, and let's down here have PP and goodwill. And this is going to be this multiplied by PP percentage. There's going to be this multiplied by the goodwill percentage. Copy that to the end, and I want those to be somewhat distinguishable, so let's highlight them in blue. Now that we have that, we can move over to the PPE. But before we do the PPE, let's add some CapEx assumptions. And this is going to be growth CapEx. So we'll have our acquired companies here. It's going to be year 1 all the way down to year 5. Just going to link to what we had up here above in our acquired companies, in our ownership assumptions. Just gonna link to those because it would be much easier to have them here instead of constantly linking to up there. Format that a bit and indent those. Then we'll have our CapEx. Here we'll need our CapEx per year for each year. I'm gonna bold it, and this will be an assumption. I'm gonna bold it, and it's a number. Let's say we'll be spending $1 million per center per year over all years. This will just be equal to this million, and I'm gonna fix the column with F4 because we may change that in subsequent years, may wanna increase the spend or decrease it, and multiply it by the number of centers. Copy that to the side, copy it down, and fix the borders. And that's how much we'll be spending each year based on the number of centers we have. And then our total CapEx down here will be the sum of the above. And we'll use that to build our PP schedule. Copy another header, paste it down here, just add a few more lines. Here we're going to take a different approach. Up till now, we would have our CapEx be equal to our depreciation, but here we actually are planning for our CapEx and we'll be calculating depreciation based on an assumption for an average depreciation percentage. So our average depreciation percentage, based on our knowledge of the industry or historical financials, but pretty much the projects that we'll be implementing, we can base this off of those projects. And for us, it's about 25%. Format it. Now we can start calculating our schedule. So we'll have our PP opening balance, depreciation, CapEx, acquisitions, and PP closing balance. Just bold that. And this one deserves a thick bottom border because it's a bit more important. And I also want to place a line on top of that just to separate it a bit better. And then similar to what we had in the other models, we'll have cash flow statement effect, which will have the payments during the period and the acquisitions of PP. And then those, format that. Okay, let's start building it. So the opening balance in each year will be equal to the closing balance from the previous year. Actually, let's make all those numbers. My depreciation will be negative, my opening balance multiplied by my average percentage, and I'm gonna fix it. Copy that to the side. My CapEx will be equal to my CapEx from the CapEx plan up above. And my PP acquisitions we can get from our price split up here. Copy that to the side. And the PP closing balance will be the sum of those. Copy that to the side, and our whole schedule is filled. Now let's link the payments during the period. So each period in relation to the acquisition will pay first the cash at close, and then we'll also have a payout of some portion of previous deals, deferred consideration. Copy that to the side, and then the acquisition of PP effect of this will be this multiplied by the PP percentage from our acquisition price split. And we can copy that over to the side. We can now link some of those. So first we can link the depreciation in our income statement with a negative sign because we're presenting it positively in our income statement. Then we can link our closing balance in the property, plant, and equipment in the balance sheet, PP closing balance. And in our cash flow statement, what we can say is in investments in property, plant, and equipment, going to be negative because it's a cash outflow, and it's going to be once the capex and also the not this one, the acquisition of PP. And we can copy that over to the site as well. Let's start building our goodwill schedule. And let me add some space here. Our goodwill schedule is going to follow a similar structure. We'll have the goodwill opening balance, we'll have acquisitions, and the goodwill closing balance. Let me just bold that and so on, a line at the top here. So the opening balance will be the closing balance from previous periods. The acquisitions will be from our acquisitions price split in goodwill portion. And the closing balance will be the sum of the two. Next, we want to calculate the cash flow statement effect, and you can just grab this here, paste it, and just change that to goodwill. So our payments for the period, we can just link them to the ones here. And our acquisition of goodwill is going to be this multiplied by our goodwill percentage from up here. Now let's link those. So first we want to link the closing balance in the balance sheet. So our goodwill closing balance will be this one here. Copy over to the side. And we also want to add the goodwill acquisition in here in the cash flow statement. Going to be negative. This here, acquisition of goodwill. Okay, and because we don't see anything getting better here, one of the reasons is that we don't have the cash linked. So let's link the cash to the cash flow statement. Okay, after the goodwill schedule, let's work on our other liabilities. Let's grab the heading again. Other liabilities. And here we'll have our opening balance, we'll have our recognized deferred purchase price, paid deferred purchase price, and our closing balance. I can grab the formatting from here and also on a line beneath the opening balance. The opening balance is the previous closing balance. Copy that over to the side. Our recognized deferred purchase price we can get from our valuation assumptions. This is our total new deferred consideration in each year. Copy that to the side. And our paid deferred purchase price we can again get from the valuation assumptions, which is this one here, what we've paid out during the period. And this needs to be with a negative sign because it should be decreasing the balance. And this is going to be the sum of those three. We can now link that in our balance sheet. So our other liabilities equal to the closing balance from here. Copy that over to the side. And now we can build our equity schedule. Add a few more lines here. So this is our equity schedule. And since we don't have any share capital, we can just do the retained earnings here. Retained earnings, opening balance, current result, dividends, dividend payments, and our retained earnings closing balance. Make that bold and formatted because it's important. remove the empty space. So the opening balance is the previous closing balance. Our current year result is equal to our income statement result. The dividend payments are going to be an assumption here, and I don't plan to add any for now, but I just want to have the functionality. And this is going to be the sum of all of those. And now we need to link them. So the retained earnings will go here. And my dividend payments will be equal to the dividend payments from here. Copy that over to the side. Those are all the additional schedules. Now let's start linking our cash flow statement and see what we missed. So our net earnings from the income statement, then we need our depreciation and amortization from the income statement again. And it seems that that was it. So everything is zeroed out in terms of checks, and we've linked everything that we had to link. So we started with some ownership assumptions, some waterfalls in terms of revenue and EBITDA. We used our common size operating expenses based on our core business. We did some valuation assumptions. We also added a debt schedule that can handle multiple loans from each year. We calculated the cash conversion cycle, the price split, the PP, goodwill, other liabilities, and equity schedules. And here we have our acquisitions pipeline model ready to go. In the next section, we'll look at building another model for a new service that we're adding to our portfolio. And the idea behind this specific model is that we have our current customer base and we want to implement a new feature that's paid separately, and it would generate an uplift on top of our already existing revenue. Thank you for watching another part of the course. As soon as the next video is uploaded, you'll find it right here. By the way, if you can spare a minute, I would love to hear your thoughts on the course and whether it's living up to your expectations. If you're watching on the website, you can do so by the feedback button up there. And if you're watching on YouTube, just drop a comment down below. Thank you.